is having small losses and bigger wins. You're always going to have losing trades. So before you take a trade, make sure that that trade has the potential of at least giving you 1.5 to 2 times bigger profit if it works than what you will lose if it doesn't. Also keep in mind that once you're in a trade and it starts moving your way, you want to move your stop closer so that, let's say you're risking 10 pips initially. If it starts moving 8 to 10 pips your way, you move your stop down in half. And if the trade doesn't work, you only lose 5 pips. So that helps you also lower your average losing trade. One nice way of determining whether a trade makes sense or not is using Fibonacci's and the Fibonacci profit target. On our software, you hit the T tool up here, and then the Fibonacci tool, or you can just hit Control F to bring up that tool very quickly. And when you left click and drag it, you will see the Fibonacci retracement levels. And once you get a nice size move of 30 to 50 pips, typically the market retraces 50% or 62%, and the trend's either going to continue down or it's not. And sometimes it also just goes sideways there for a long time. But your Fibonacci profit target levels, in this case 2786, if you were to go short, let's just say all the way down here, you have about a 35 pip profit. And that's, at least 1.5 times more than what your stop would be if it's above the swing high here. And it makes a great place to exit half your trade and then let your trailing stop handle the other half of your trade. Or if it gets hit and the market kind of goes sideways and then you get a double bottom at especially the 1.618 most of the time is the end of the move. Now obviously the euro was extremely weak today. If you use our currency meter, you would have known that it wasn't likely to reverse. But the Fibonacci profit target levels are excellent places to exit half or even all of your trade. Let's look at some other examples. Again, notice it came almost to the pip to the 50% level, and it came down to the Fibonacci profit target level. And sometimes it hits it to the pip and reverses, and other times it shoots past it by 1 or 2 pips. If you're in a trade and it shoots right past the first one, and it looks like it's going to hit the second one, by all means, don't exit half your trade there. If it's moving violently in your direction, hang on and let the market forces, give you more pips in those situations. And also, sometimes when the market's super weak like this, you're going to need to draw your fibs on the entire wave to get an idea of where the next level is. And as you can see, look, the market fell like a rock, a tremendous amount of pips, about 55, 60 pips, and it went sideways here for half an hour because there was major buy orders there at the Fibonacci profit target level. What I also think to keep in mind is on any size move like this, it's very big. Rarely do markets go below the 2.0 level. So you can also use this as a if you're in a trade that went sideways here and you exited half, and then the market kept going and going and going, there's no need to let your trailing stop possibly get you out here at 42 when you can get another 10 to 30 pips on the trade. The 2.0 level is very much likely most times to be the end of the move before having some kind of a pullback, and then the trend continues again. Just notice how many times markets hit Fibonacci areas. You see that? 1.618. Got hit, got hit, got hit. The market wasn't able to pull back, and then it exploded up again. And notice the Fibonacci area on this. Look where the market stalled. Fibonacci areas are phenomenal places to, this went up a lot, and then it went sideways and went up a lot again, and sideways for half an hour. After a big move up, another big move up, typically the third wave up, the market's likely to have a deeper sized pullback. So in this case, normally you want to exit half your trade at the Fibonacci profit target levels. If a market moves up 1 wave, 2 waves, and you're on the third wave, and it's gone up a tremendous amount of pips, by all means, consider getting out near the first Fibonacci profit target, not waiting for the 1.618. Another tool that works in conjunction with this is our range projection. If you set this for 1440 minutes, that's the number of minutes in a day. And I like to put 1 standard deviation on here. And this gives you an idea. This is how far the normal average daily high is. This is 1 standard deviation, and the number of pips from here to here is a 2 standard deviation. There's actually a 95% chance that the market's going to reverse at and very close to the 2 standard deviation level. As you can see, that's here. So that was another reason in this instance, if you were to buy the breakout of this little flag pattern right here, to be getting out at the 1.382 fib target, because it's 95% likely, based on the past 20 days averages, to completely run out of buyers up here. Let me just show you that on some of the other currencies today. Notice the euro dollar, the 95% level, reversed. Euro yen, also the 95% level, it reversed. Let's look at the dollar CAD. This one went to the normal daily high, and it really kind of went sideways all day and then went up. And it's very hard to draw fibs when the market just keeps going and going. One way that you can is to use our range projection. So it actually gets tick data, and it creates each bar based on a certain number of pips. So let's say you want to have a 6 pips per bar. Put 6R in here and hit enter. It's going to download tick data, and it's going to draw each bar after it moves 6 pips. So the bar could open, go up 6 pips, and then you have a new bar, and so forth. So on a range bar, notice this little pullback right here. You can now draw your fibs on this. Can you see that? Look where it went, to the pip. It's uncanny how well this works. On minute-based charts, occasionally you can't draw Fibonacci areas, but you can on range charts. You see that? When it's above the daily high and it comes up to the fib target, this is an excellent place to do a counter-trend trade. And even if you got short here and got out after it pulled back 25 pips, you are risking less than 10 pips, because with a range bar chart, you can use each bar's high or low as your stop placement, plus 1 or 2 pips padding. So your stop's always less than 10 pips using a range bar.